ETFs or mutual funds? Which one is right for your portfolio? In today's video, we're going to be breaking down that exact question, ETFs or mutual fund debate, explaining liquidity when we see both of these, what the fees are behind them, and also the tax efficiency that we see. And I want to share how one of these might be the right investment strategy for you. So stick around because I'm also going to provide some real world examples of some of the most popular ETFs and the mutual funds that are used today. So welcome back to the channel. I cover investing strategies to help you build wealth. Today's topic, ETFs versus mutual funds, how to choose the right one. This is one of the absolute biggest search questions that we see on YouTube. So let's jump into it and go through the key differences that you have to know when it comes to investing. An exchange traded fund or an ETF is a basket of investments. When you look at stocks, when you look at bonds, even other assets, they trade just like a regular stock would. You can buy and sell them throughout the day at regular market prices. And one example of this is one of my favorite that I hold personally in my portfolio, which is the S&P 500 or the VOO, which is the Vanguard S&P 500 fund. It gives you instant exposure to the 500 largest companies in the United States. When we think about Apple, Microsoft, Amazon, Nvidia, it is one single purchase into one single ETF, giving you instant diversification in a very, very low cost. Now, another ETF that we like is the Vanguard Total Stock Market ETF or the VTI. This gives you access to every single company in the United States, 4,000 plus companies across the entire market. Great example of how ETF investing can really be very broad, very simplified when it comes to investing. On the flip side of this, we look at mutual funds. It is a pool of investments. So they're actually taking a lot of different investors, putting the money together, but it doesn't trade during the day. Instead, it only trades at market close. So you only get one chance, one shot at whatever the price is for that mutual fund. An example of this is the Vanguard 500 Index Fund or the VFIAX. It is the mutual version fund of the S&P 500, which we have the VOO. Investors are buying the same companies, except they only get to invest one at a time, and it doesn't happen at real time. You just get that one time, one purchase at the market close. Now, another example of this is the Fidelity Contrafund, very well-known, very popular mutual fund. Unlike ETFs that track the index, this is actively managed, meaning there is actually people that are picking the stocks they believe are going to outperform. This shows the strength of the mutual funds actively managed by people. When we start looking at the funds in the ETF category of the VOO or the VTI, they are passively managed. They follow and track a specific index, where again, some of these mutual funds are actively managed. Now, with it being actively managed, you are paying for the fund manager. You're paying a little bit of a higher fee, and that's what we're going to get into with these mutual funds. So some of the key differences, the first one we're going to look at is the trading flexibility. First, and really the major difference is the liquidity and the flexibility when it comes between these two investment vehicles. The ETFs, they trade all day long. Like we've seen, a regular stock, you could buy the VOO at 10 a.m. You could sell it at 2 p.m. if you wanted to, because it is going to trade all day long. On the other side, mutual funds only trade once a day. They do not trade intraday, meaning if you're buying it at noon, you're going to get the price which is set at 4 p.m. when the market closes. For investors who want real-time investment strategies, ETFs are the clear winner on this one. But if you're dollar cost averaging into retirement accounts, doesn't really matter about the intraday moves because you're going to be doing those investments on a consistent basis. This is where mutual funds will still work fine. Now, the second key difference in this, in my opinion, is probably the absolute biggest one when it comes to fees and the cost. Now, ETFs, thinking of the VOO, super low, 0.02%, meaning on a $10,000 investment, you're paying about $2, or I believe it is $3. It might be a 0.03 within that VOO, which is super cheap, guys. You're paying literally dollars on a $10,000 investment. On the flip side with mutual funds, even looking at the same one that tracks the S&P 500, 0.04, which is still very low. However, you have the actively managed funds, meaning that some of the Fidelity Contrafunds are a little bit closer to a 0.8% every year, so almost 1%, meaning that on that same $10,000 that you invested, you would have to pay $80 annually. Now, I have also noticed with some of the mutual funds, not only do they have a cost to go in and buy the fund, there can also be sales loads, there can be transaction fees, there can be monthly fees, there could be advisor fees. There are a lot of things attached to mutual funds that a lot of people do not realize that I've seen, And being in the financial industry for almost 20 years, it's interesting because a lot of those extra fees within the mutual funds can absolutely drag down your portfolio when it comes to a multitude of years. Another one to think about, a key difference, is the tax efficiency. This is a big consideration when it comes to investing. And honestly, it's probably one that most people forget about or don't think about until it's too late and they feel this. Now, ETFs have a very unique structure that allows them to minimize any taxable event. If you hold something like the VOO, you're unlikely to get hit with a big capital gains distribution unless you're selling it. So just buying and holding it, very, very little when it comes to taxes on that. On the other side, mutual funds, even if you didn't sell any funds, the fund itself might pass on capital gain distributions if the manager sold any securities during the year. And I have seen this happen a couple times. That might mean that you end up the end of the year with a bigger tax bill than expected because the manager that is managing that mutual fund bought and sold different stocks, different shares, different things within the fund itself. For investors in a taxable brokerage account, ETFs are much more efficient when it comes to actually investing with the tax efficiency than we see with those mutual funds. Now, another big one for new investors, if you are new to the game, I got some links down below for M1 Finance and Robinhood. The big thing with some of the key differences, minimum investments. When you look at ETFs, it is definitely worth noting you can buy them at one share, you can buy them at fractional shares. Some of these houses take $10, even $25. Mutual funds on the other side usually always have minimums, or majority of the time do have minimums. It might be $1,000, it might be $2,500, could even be $3,000, $5,000, even $10,000 to get into those mutual funds. And that is an upfront investment. So even thinking of the VFIAX, which again tracks that S&P 500, there is a $3,000 minimum to get started. If you're an investor like me, you could go in, you could get those ETFs at the exact same cost, that track the exact same index, and get them at a fraction of cost. That can be a really big hurdle for beginners if they want to start investing. So looking at some of the pros and cons, we'll do a quick recap here, guys. When it comes to ETFs and mutual funds, ETFs offer that intraday trading, lower fees, more tax efficient, easy, very easy to start small if you're a new investor. Downside, you can really be tempted to do short-term trading if you don't know exactly what you're doing, whether it's stocks, whether it's ETFs. If you're trying to be a day trader, a lot of them, unless you're really good at it, get absolutely burned. Investing in ETFs and holding and not selling for an extended amount of time can make you a multimillionaire with regular contributions through dollar cost averaging. On the other side, with mutual funds, very good for those automatic contributions, often available in a lot of retirement accounts, and that's where we see them in 401k plans. Some even offer active management, but they usually have higher fees, a lot less liquidity, and higher minimums to get in there. So guys, ETFs or mutual funds, which one should you choose? If you want the flexibility, you want the lower fees, you want tax efficiency, some of the ETFs like the VOO or the VTI are absolutely better options. If you're investing through a retirement plan and you prefer to actually have a person manage those investments, mutual funds like the VFIAX or the Fidelity Contrafund could be an absolute perfect fit. The biggest and the most important key difference, you got to know, guys, to make the right choices when it comes to your goals. If this video helped you, hit that like button, subscribe to the channel, and drop a comment. Do you invest in ETFs, or do you do mutual funds, or do you do a combination of both? I would love to hear the strategy, and I'll catch you in the next video.